On Saturday, the 28th of February at exactly 1:15 a.m. Eastern Standard Time, coordinated missile strikes began hitting targets across Iran. Within hours, global panic had set in, but the world's financial plumbing was completely frozen. The New York Stock Exchange was shut, the Treasury market was dark, and the CME Commodities Exchange wouldn't open for another 40 hours. The only place on the planet where you could watch the geopolitical risk of a Middle Eastern war being priced in real time was a decentralized crypto exchange. My name is Guy, and you're watching the Coin Bureau. So, are we looking at the ultimate validation of decentralized finance? Is the migration of traditional commodities onto public blockchains the breakthrough we've been waiting for? Or is this actually a terrifying glimpse into a hyper-financialized future where the market never sleeps and retail traders are the ultimate exit liquidity? Well, that's exactly what we're going to cover today. First things first, though, let's look at the sheer scale of the financial blackout that occurred during the final moments of February. When the initial wave of US and Israeli strikes hit Iran, the traditional financial system was entirely paralyzed. Investors holding stocks, bonds, and traditional commodities had absolutely no exit liquidity. They were forced to sit on their hands and wait for the Monday morning gap down. But the crypto market didn't have that sort of time cushion to absorb the macroeconomic shock. Bitcoin, which had been trading near $65,500 just prior to the news, immediately plummeted to roughly $63,000. That initial drop wiped out over $300 million in leveraged long positions across centralized exchanges in a matter of hours. And by the time traditional markets finally opened on Monday, the S&P 500 had cut its losses after falling 1.2% at its lows. And the VIX Volatility Index was on its way to surging 24% to approach the critical 30-point panic threshold. But here is where the story gets genuinely fascinating, because price discovery didn't actually stop over the weekend. It just migrated entirely to decentralized exchanges. While Wall Street was offline, a decentralized perpetuals exchange called Hyperliquid became the de facto global pricing mechanism for real-world commodities. Here's how it works. Hyperliquid uses a framework called HIP-3, which allows for the permissionless listing of traditional financial assets. These are perpetual futures contracts that track the price of an asset like oil or gold, but they never expire and they settle instantly in USDC stablecoins. During the weekend strikes, the oil-linked perpetual contracts on Hyperliquid jumped more than 5% to $71.26 per barrel. Silver perpetuals saw an astonishing spike in activity, logging over $1.1 billion in a single 24-hour trading period. And gold contracts saw roughly $173 million in weekend volume, while the traditional COMEX exchange sat completely dark. Traders were effectively pricing in the geopolitical risk of the Iran war before traditional brokers even unlocked their doors. It proved that 24/7 blockchain infrastructure is fundamentally superior to legacy banking hours. And speaking of tracking these macro moves before they hit the mainstream headlines, that's exactly why you need the Coin Bureau Telegram channel in your life. It's where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates too, all pinged directly to your device so you don't miss a thing. Whether it's a weekend geopolitical shock or massive ETF flows, our members see it first. So sign up today using the link down below or by scanning the QR code on the screen. Okay, back to the weekend's action. Now, you might be thinking that this is a massive victory for crypto infrastructure, and in many ways it is. But the reality is that this 24/7 access comes with a pretty scary cost. While the crypto market never closes, its liquidity does not stay constant. According to research from Amber Data, the crypto market's liquidity has a distinctive 24-hour rhythm. Peak liquidity hits around 1100 UTC when Asian, European, and American trading desks overlap. But over the weekend, when institutional market makers log off, order book depth collapses. Post-crash data showed order books were roughly 40% below their pre-crash levels. So, When a geopolitical shock hits on a Saturday, the market is structurally starved of the capital needed to absorb the panic. And that brings us to the harder question that the 24/7 trading narrative is actually masking. Because thin liquidity is just the match. The dynamite is cross-margin leverage. When Bitcoin dropped to $63,000, it didn't just trigger a few stop losses. It ignited a cascading liquidation doom loop. You see, in a cross-margin account, your entire portfolio acts as collateral for all of your open positions. If one highly leveraged trade goes against you, the exchange automatically force sells your assets to cover the margin. That forced selling pushes the price down further, which triggers the next layer of liquidations, and the cycle repeats itself. And we saw the brutal reality of this ongoing cascade on the 8th of March, when over $300 million in crypto positions were liquidated in a single 24-hour window. And according to Coinpedia, 91% of those liquidated positions were longs. Over $270 million in bullish bets were systematically destroyed because retail traders were caught off guard by a weekend headline. Now apply that exact same vulnerability to the $26.4 billion in tokenized real-world assets currently sitting on public blockchains. BlackRock's Biddle fund alone has grown to nearly $2.9 billion in value, and it is now being accepted as collateral on major trading platforms. When you allow traders to use tokenized US Treasuries or tokenized gold as collateral for leveraged crypto bets, you are directly connecting traditional safe haven assets to crypto's weekend liquidation engine. And as BCG estimates that tokenization will surpass the $7 trillion global ETF market to reach $16 trillion by 2030, this weekend volatility is going to bleed directly into traditional commodities. And that could get real ugly under the right, or should I say, wrong conditions.
What's the verdict?
Well, first off, the legacy financial system's 9 to 5 operating hours are a relic of the past. The recent geopolitical crisis definitively proved that when the world needs immediate price discovery, it turns to decentralized crypto infrastructure. The genie is out of the bottle, and traditional exchanges like the NYSE are already scrambling to build their own 24/7 tokenized platforms to catch up. But the notion that this is a purely positive development for the average investor is completely overstated. Until deep institutional liquidity stays active over the weekend, crypto will continue to act as the world's financial shock absorber. And that means punishing over-leveraged retail traders every time a headline breaks on a Saturday. We're witnessing the birth of a truly global, always-on market, and the growing pains are going to be absolutely
brutal.
But what do you think? Is a 24/7 financial market the ultimate goal of crypto, or does it create too much dangerous volatility for retail traders? Let me know in the comments down below. And if you want to understand how the multi-trillion-dollar tokenization trend is reshaping Wall Street, well, you can check out our video on that right over here. Okay, thank you all for watching, and I'll see you again soon. This is Guy, signing off.